So just a few days ago on this YouTube channel, I posted a video on why I believe there's a better chance we're going to have a recession in 2020 than we don't have a recession in 2020, which is the first time in my adult life I have ever thought that. And this video freaked out a lot of people because I'm usually a very optimistic person. I don't usually have negative thoughts about the market in general, and I've never once thought going into the next year that basically there was a better chance of having a recession than not. So it's kind of a big deal. It's not like I'm just someone that predicts, oh, we're gonna have a recession next year, like some people do. They say every single year we're gonna have a recession, and then eventually they're right? I'm definitely not one of those people. This is the first time, in 2020 that I've ever thought there's a better chance we'll actually have one. In that video, I went into detail on that, okay? But a lot of people are saying, well, Jeremy, you believe that. Why not sell off all your stocks right now, okay? And this is such a deeper subject than what it seems, okay? As with all things in finance, it's a lot more complicated than just an easy answer, okay? So if we look here, I want to start out here looking at the 5 worst one-year performances in the history of the S&P 500, all right? And if we look at anything in the modern history, basically 1970s and over, we're going to see 2008 was the worst S&P 500 year ever as far as performance went, down 38.5%. 1974 was the second worst year, down nearly 30%. 2002 was the third worst year in the history of the S&P 500, down over 23%. And 1973 was the fourth worst year in the history of the S&P 500, down over 17%. Now, for some context, in 2018, the S&P 500 was down a little more than 6%. A lot of people got destroyed in 2018. So imagine, a market that's down 15%, 20%, 30%. Obviously, it would get a lot worse out there. So what I want to look at here is what years did we have recessions during some of those worst S&P 500 years, okay? So 2008 obviously was the Great Recession, which was arguably the worst economic climate we've had since probably the Great Depression. The whole banking system in the United States of America nearly failed. $700 billion plus TARP plan had to come out. Like, it was an absolute disaster, and it took several years just to kind of get the economy back on the right tracks, okay? So obviously 2008, the worst performing year in the history of the S&P 500, it kind of makes sense, okay? It was a bad time, okay? 1974, that was a year the S&P 500 was down nearly 30%. Was that a recessionary year? Well, yes, okay? This covers not only the horrible year in 1973, but also the horrible year in 1974. It was a very deep recession at that time. They called it stagflation, where basically there was high unemployment and there was high inflation all at the same time. And so that explains why 1974 and 1973 were such negative years, 2 horrible years back to back, negative 17%, negative 30%. Like, that is awful, okay? And then if we look at 2002, which was the third worst year in the history of the S&P 500, down over 23%, we're going to find that there were a lot of different things at play in the early 2000s, okay? Some people argue, well, there wasn't technically a recession because there was no 2 consecutive quarters of negative growth. But we had a lot of negative things going on, right? First off, there was a September 11th attacks. Obviously, that's probably the most dramatic day since Pearl Harbor in the United States of America. That just affected the whole economy, very negative, the whole mindset around it, okay? We're also coming off of the tech bubble, which popped in 2000. That was a huge negative situation for the markets in general. Then you had the war in Afghanistan, which started in 2001. You obviously had us leading up into a lot of people thinking we were going to have an Iraq war. Sure enough, we did, going into 2003. So if you look at 2002, why that was such a negative year wasn't just because the economy was kind of weakening and it was kind of just a blah economy, but we had a lot of external events going on that basically affected the market in a very negative way and took the sentiment into a very negative place, okay? So that kind of makes sense. So needless to say, if you have a recession, especially a pretty big one, the stock market's going to fall quite a bit, okay? So here's my opinion. If a recession hits in 2020, we're going to see the stock markets fall somewhere between 15% and 30%. 15% is kind of the best case scenario, and around 30%, in my opinion, is around the worst case scenario if we actually do see a recession in 2020, which is my opinion, where there's a better chance we'll see one in 2020 than not see one in 2020, okay? And here's the thing, okay? A lot of people are dreaming about, the markets falling and wishing the markets will fall, a 40% type move like we had in 2008. And that I can say pretty much dream on. Why is a situation like that pretty unrealistic? And a lot of people are thinking, oh man, I hope the market falls like 50%, 60%, 70%. And in my opinion, kind of dream on. Why, okay? Well, one, the government wouldn't allow it. They would just, ramp up quantitative easing again. again, start printing money, just buy assets like crazy. That's what the Fed would end up doing, okay? That's just one reason. Another reason is there's a lot of people sitting on a lot of cash right now, kind of prepping for if something does happen and asset prices go down quite a bit, okay? You look at Warren Buffett, for example. They got well over $100 billion just sitting around in cash right now, okay? Gary Vaynerchuk, he's been on record for years now, basically saying he's just sitting on cash and has been sitting on cash. There have been countless fund managers and businessmen who have just been having money on the sidelines, sitting on the sidelines saying, hey, we're going to wait out for the next one to come. But here's what happens. All these people with all this money on the sideline, right? All of a sudden prices do start going down. Well, guess what? They're going to start buying and buying and buying assets, whether we're talking real estate, stocks, bonds, anything across the board, because they have a lot of money to deploy. Prices are going to be way down. They're going to buy and things are going to go up very quickly. Even if you look at what happened in the 2008 recession, right, which was arguably the worst we had in a long, long time. The banking system was a disaster. Even in that one, we still had the markets bounce back in a very quick amount of time. Here's a chart I'm showing you, which basically starts at the beginning of January 2008, and it goes through the end of 2009, about a 2-year span, all right? Where you see the markets just fell off a cliff from S&P 500 at, 1,400 plus, to next thing you know, in a very quick amount of time, it was under 700. But then you look, and all of a sudden, 8-9 months later, the S&P 500 goes from under 700 to 1,100 in a snap of a finger. And that's what happens when you have the market go down in a substantial way like that. You have a lot of people who are already kind of planning on it or maybe had cash ready, okay? And they say, okay, when assets start going down, we're going to buy. And in a very quick amount of time, the assets just start rising again. You have government step in with quantitative easing, say, hey, we're going to buy assets. You have them, which pushes a lot more money into the markets. And it's just what happens, okay? So everybody that's hoping the markets go down 50% or 60%, I just say probably dream on in that situation because it's very unrealistic. If we do have a drop in 2020, we're probably looking at a 15 to 30%, okay? That's something to take into account. And also, if you look at the worst year ever in the history of the S&P 500, which was 2008, we got to remember that was an unprecedented time where banks had gotten completely out of control, okay? There was a TARP bailout plan, which was $700 billion. A lot of people didn't even favor that because they said, oh my gosh, we're going to move towards socialism with this whole plan and things like that, right? That was an unprecedented situation in the history of America pretty much. And in my opinion, next recession, or is the whole banking system going to fail like that? No. Will banks get hurt? Will everybody get hurt? Absolutely. Everybody will get hurt. But if you're thinking, oh my gosh, we're going to be a 2008 situation, I just think that's a hard thing to predict, okay? So here are my goals for if we're looking at where do I want to be January 1st, 2020 as far as financially goes. Here are my goals, okay? I want to be 50-50, okay? 50% stocks and 50% cash. Now, this is assuming something very big. This is assuming the Dow is 25,000 plus, okay? And this is assuming the S&P 500 is 2,700 plus. If the market started to fall in a major way in 2019, I would probably start buying assets, okay? And into 2020, let's say things happen even faster, okay? Let's say, at the end of 2019, things start to disintegrate. We actually start going into a recession in the US. I'd probably start buying some assets there, here, and there, okay? But assuming the markets are where they're at today or higher than they are today as of recording this video, I want to be somewhere around 50-50 cash. 50, and I'll have a hedge position essentially where let's say nothing happens in 2020. The economy just booms or the economy is just doing decent, okay? And the markets do decent. Well, I got still a significant portion of my net worth in stocks. But if something does happen and things get ugly, I'm going to have a substantial cash position that I'm ready to buy assets like crazy, okay? And here's kind of my thoughts, okay? This is a picture of a guy in the California gold rush, right? So you got your pan and you're waiting on the river, right? And you're trying to get your last few chunks of gold to come out, right? And there's a chance you could get a few last chunks of gold to go down the river. But the problem is, there's been a million other people that have already been sifting through that gold for years now, and the chances you're even going to get any chunks, or you're going to get, maybe a few chunks, it's a very small percentage. And that's kind of my view on the stock market and assets in general right now. You're kind of toward the tail end, and could you get a few more chunks? Could you get another 10% out of the stock market or 20% gain out of the stock market? It's possible, but when you look at the downside risk could actually be much more substantial than that. So that's just kind of my opinion on the markets right now when you kind of look at full employment right now, when you kind of look at, the stock markets being at near all-time highs right now, when you kind of look at us being in the credit cycle toward the end, maybe 7th, 8th, maybe even getting close to the 9th inning of this game, right? So in my opinion, that's why I'm going more heavy cash than I've ever been. Most years when I enter them, around probably 10 to 20% cash, okay? There's been times I've been up to 30% cash, but most years I'm 10 to 20% cash. I plan on going into 2020, assuming the markets haven't already crashed or something like that, I plan on going in with around 50% cash. So in terms of selling off all your stocks or something, I think you have to have a really strong conviction that, you know, it's the end of the game or something like that. In my opinion, I just like to have my position hedged. I got a significant portion of money in stocks, but I'm also building a significant portion of cash right now, ready to deploy if, you know, everything plays out the way I think it probably will, or there's a better chance of it playing out, which is a recession coming in 2020, than not a recession, guys. So that's my opinion on that, and that's why I'm making those moves. And you know, absolutely, if there is a recession in 2020, expect the markets to fall. They will fall, but in my opinion, you'll probably see somewhere around a 15 to 30% fall in the markets if we do have a recession, which is a big if. You know, I could be wrong, and everything's, you know, copacetic, and, you know, we grow and grow and grow, and that's great. But eventually, the bells are going to toll, guys. But anyways, let me know what moves you are making out there in the market down there in that comment section. I would love to hear from you guys. As always, make sure you hit a thumbs up if you enjoyed this today. Thank you for watching. Have a great day.